Welcome back to Synaptic Dividends.
All right, today we're tackling a big one. Is PepsiCo's dividend, the one so many people count on, a truly reliable source of passive income, or is it maybe running on fumes? To get a real answer, we're going to put it through a little stress test, a three-pillar test, actually. We'll look at its safety, its growth, and its resilience. So let's get right into it, starting with the big one.
Okay, pillar one, the safety check. And this is, the most important question we can ask. Can PepsiCo actually afford to pay us this dividend? Because if it can't, nothing else matters, right? This is the foundation.
So to check on safety, we look at something called the free cash flow payout ratio. I know, it sounds super technical, but it's really not. Just think of a company's free cash flow as its take-home pay. It's the real cash left over after all the bills are paid and after they've reinvested in the business. This ratio just tells us, hey, what percentage of that leftover cash are they using to pay out dividends? And pretty simply, the lower the number, the safer it is.
So, what's PepsiCo's number? Well, get this. Over the last 12 months, it's 109.2%. Yikes. Yeah, you heard that right. That means they paid out more in dividends than they actually brought in as cash. So is that a giant red flag? Are we done here? Is this the end of the story? Well, hold on. Not so fast. See, a single year can be tricky, and that high number is mostly because of the timing of some major investments. What we really need to do is zoom out and look at the bigger picture. The long-term average is what really matters. And over the last 5 years, PepsiCo's payout ratio is a much healthier 86.9%. So yeah, it's something we need to keep an eye on, for sure. But the long-term trend shows us that the business cash flow absolutely covers the dividend. So safety check? I'm going to say it passes.
All right, so the dividend is safe. That's great. But, safety is just the first step. A great dividend doesn't just sit there. It needs to grow. It has to grow faster than inflation. Otherwise, you're actually losing money over time, right? So for our second pillar, let's check out PepsiCo's growth engine. And really, when it comes to growth, there's one number that tells almost the whole story. And that number is 52. So what's so special about 52? Well, that's 52 times consecutive years of dividend increases. Think about that. Every single year for over half a century, they've given their shareholders a raise. That is just incredible. It's the kind of track record that earns a company the very special title of Dividend King. And that's a club for only the most elite, most reliable dividend-paying companies in the entire world.
And look, this isn't just some tiny increase every year to keep a streak alive. We're talking about real, meaningful growth. Just look at the consistency here. Whether you're looking at the past 3 years, 5 years, or even 10 years, the growth rate has been chugging along at over 7% a year. That is exactly the kind of steady, predictable growth that we, as long-term investors, love to see. So pillar 2, growth? Yeah, that's looking rock solid.
Okay, we're on to our final and, honestly, our toughest test. It's easy for a company to raise its dividend when the sun is shining and the economy is great. But what happens when everything hits the fan? What happens when there's a real crisis? This is the ultimate stress test. This is where the truly great companies prove their mettle.
So let's look at the two biggest economic meltdowns of our lifetime. First, the 2008 global financial crisis. Remember that? Companies were going under, other blue chips were cutting their dividends left and right, and what did PepsiCo do? They raised theirs by a whopping 24%. Then, fast forward to a COVID-19 pandemic, total chaos, massive uncertainty, and they did it again, grew the dividend right through it all. That tells you everything you need to know. For them, paying and growing this dividend isn't just some nice little bonus, it's a core promise. It's non-negotiable.
So, we've put PepsiCo's dividend through our three-part stress test. We've checked its safety, its growth, and its resilience. So, what's the final call? Well, I think the numbers pretty much speak for themselves. Let's just recap. Pillar 1, safety? Yep, it's covered by long-term cash flow. Pillar 2, growth. With 52 years of increases, it's basically dividend royalty. And Pillar 3, resilience, it just laughed in the face of two of the worst crises we've ever seen. So, back to our original question, is PepsiCo's dividend rock solid? Based purely on these numbers, the answer has to be a resounding yes.
Now, as powerful as these numbers are, they're really just part of the story.
If you want to go deeper and really understand the full business model, the competitive advantages, and the management team that makes these numbers possible, you should check out our long-form analyses on our main channel, Synaptic Investing. Thanks for joining me.